Very interesting. So you have country A, so you have country R, country S, country R and country S. This is RCO. R resident country, S source country. RCO, this is the resident. Resident of a country is a person. Resident of a country is a person who is liable to tax in a country, who is liable to tax under the laws of that country because of domicile, residence, place of management, or any other criterion of a similar nature. So, RCO, resident of R. RCO has a permanent establishment. RCO has a permanent establishment and RCO is incorporated or place of effective management, whatever might be the criteria. This Arvind, Chetna and Vaibhav, you know that the firm lines, they denote a legal entity and the dotted lines, they denote a permanent establishment, because permanent establishment, permanent establishment is not a legal entity. Mr. Nishant, dotted line indicates permanent establishment because permanent establishment is not a distinct legal entity. Permanent establishment is simply an extension of the legal entity RCO. Fine. So RCO is a legal entity and this is the PE. As against this, I'll also draw here. Here you have R and S and you have RCO and then you have SCO. So here you find that these two are distinct legal entities and therefore the lines are firm. Fine. So distinction. Distinct and distinct. So this is the difference. Dotted line, permanent establishment, not a distinct legal entity. Okay. Permanent establishment, Article 5.1. Permanent establishment, RCO does business. RCO does business in S with the help of a permanent establishment. Don't worry, we'll discuss that. But then, so when it does business, supposing this is a manufacturing entity, it manufactures and then ultimately sells. It is selling. RCO is selling certain items in S state with the help of this P. So selling, it sells, selling, it sells the manufactured items. When it would sell, it would also gain revenue, income. So this is the income. It is the income. Fine. And then ultimately this income, because see, this is not a legal entity. PE is not a legal entity. So ultimately this income would flow from the PE into RCO, because the ultimate legal entity is RCO. This income is entering into PE and it is ultimately landing into hands of RCO. Supposing this income is $100. Corporate tax rate of S is say 30%. 30% corporate tax rate. Here it is 40% tax rate. S says, remember customary international law. Customary international law recognizes the right of the source country to tax any income which has the source in that country. This 100 has the source in S. So S says this 100 is my source income. This income is source in my country. I will tax. And S imposes 30% rate. So 30% tax. $30 S collects. So 100 minus 30. So 70. Right? So effectively in the hand of RCO, when the income reaches RCO, it is only 70. It is only 70. Because 30 has gone. 30 has been deducted as a tax paid by RCO in S. But country R tax authorities, they say nothing doing. R says, but R would say, RCO, you are my entity, you are my resident. You are my resident. And for me, you are earning is 100. I am not concerned with any tax that you have paid in S. For me, you are earning 100. 100 is easy. I will impose tax on 100. What is my tax? 40. So it imposes tax on this 100 as 40, and therefore minus 40. Sorry. This was 30. 30 here, and now 40 more. So minus 40. 40 is collected by R, 30 was collected by S, and the net income in the hand of RCO is only 30. 70 gone tax. 70 gone tax. So you find that this 100 income, same income in the hands of the same taxpayer RCO. Same income 100 in the hands of the same taxpayer RCO for the same time period, same financial year. Same income, same taxpayer for the same time period is taxed twice by two legal authorities, two sovereign entities, R tax authorities and S tax authorities. When this sort of a situation happens, this double taxation is known as juridical double taxation. Juridical double taxation, or JDT, also known as legal double taxation, also known as international juridical double taxation, also known as international double taxation. All these are same. JDT or legal DT or international JDT or IDT is basically JDT. Why juridical? Why legal? Because there are two entities which are taxing the same income of the same taxpayer for the same time period. Twice taxation, double taxation. This is juridical double taxation, and this is clearly not desirable. This creates obstructions in the cross-border flow of capital. This sort of situation creates hindrances in the development of international economy, global trade, and that is why right from the beginning, that is 100 years, 1923, even before that, authorities in various countries have been very mindful of this sort of situation, and that is why tax treaties have been created. This sort of JDT is relieved. This JDT is taken care of by tax treaties. So JDT, relieving of this JDT, providing relief for this JDT, avoiding this JDT, or if you cannot avoid, providing relief for this JDT is the most important objective of a tax treaty. Remember, avoiding double taxation. So that double taxation was actually JDT. So this JDT is the objective of a tax treaty. I hope this should be crystal clear to everyone. Arvind, Chetna, Nishantak, Bhagav. Yes?
Yes.
Right? This is JDT. Come to second aspect. As against JDT, so ultimately what will happen? This sort of situation occurs when there is no tax treaty. So ultimately what will happen? RNS will enter into a tax treaty. RNS will enter into a tax treaty, and then some sort of arrangement will take place. R will say okay, because S is taxing. Because you know what? This is a typical, I'll tell you. This is R taxes 100 because R says that this 100 is earned by my resident RCO. So this R applies residence based taxation, jurisdiction to tax. S taxes is 100 because S says that this 100 is sourced in my country. So there's a conflict. R is applying residence based taxation, S is applying source based taxation. This conflict is known as RS conflict. And whenever you have a conflict of R and S, as when they enter into a tax treaty, treaty resolves this conflict. How? Treaty would say that S will tax. S will tax, source, right to tax. S will tax and R should not tax. R should not tax. So what will happen? That R will not tax. So this 40 goes away. Only taxes 30. Right? This is one of the ways by which this double taxation, this JDT will be relieved. Fine? Okay. Second double taxation is EDT. Economic double taxation. Economic double taxation. What is economic double taxation? Economic double taxation ARCO is the parent, N is the resident. ARCO is the parent, is the resident. ARCO is the parent company, it is the resident of R. ESCO is the resident of S, resident. ARCO infuses equity, capital contribution, and then ESCO will do business. ESCO sells, for example, something, it's in the business of selling, it sells. It earns income. So when ESCO will earn the income, when ESCO will earn the income, S tax authorities will impose a tax on this income, corporate tax. Why? Because ESCO is the resident of S. So S tax authorities will impose a tax on this income. Okay. ESCO pays the tax. And now, because ESCO has equity contribution, so ESCO will give dividend. ESCO will give dividend to ARCO. And when ESCO gives a dividend to ARCO, S again imposes a withholding tax on these dividends. Now withholding tax, this first tax is the tax on ESCO. This second tax, withholding tax, is not the tax on ESCO. Withholding tax is the tax on ARCO. But then, because ARCO and ESCO, they are MNEs, multinational enterprises, and they belong to the same MNE group. That is why they are economically one single unit, because MNE group is the same. Because they are economically a single unit, and because this income is getting tax here and then tax here, that is why this is known as economic double taxation, EDT. One of the examples of EDT.